Welcome everybody to Real Estate Wealth Building Strategies, which is presented by NAREA. And I see that we have a good group signed up. So let me begin by introducing our company, the National Association of Real Estate Advisors. We call ourselves NAREA. And our goal is to educate real estate professionals and investors all over the country on how to list, lease, invest, and buy and sell real estate. There's two ways to become a member of NAREA. You can join for free as a basic member, or you can sign up as a pro member for $199 a year. All members receive our monthly e-newsletter, and it's called NAREA News, and also have access to the media center and the discounts from affiliate partners. The pro members get the added benefits of receiving discounts on the Certified Commercial Advisor Designation Program and the other educational classes that we provide to our members. Plus, they get the investment analysis tools and fillable contracts and forms all for free. So pro members are even highlighted with a personal profile on our website, which is nareagroup.org. My name is Ken Holman. I'll be the presenter today, and I'm president and founder of NAREA. I'm also the president of Overland Group, Inc., which specializes in both commercial and residential real estate brokerage, development, construction, management, investing. We've developed about every property type, but we're particularly interested in self-storage and apartments. Those are two of our hot buttons. I have an undergraduate degree in accounting from BYU and an MBA from the University of Utah. And I hold several of the top designations in the real estate industry. Our company, Overland Group, it's been around for about 30 years, and it's a fully integrated real estate company, as I mentioned. What that means is that we're capable of handling almost every piece of the real estate puzzle, which is a real key to our model. And we find that by controlling most of the pieces, we can keep costs down, as well as ensure that construction, development, and management are all working together harmoniously. Now I'd like to introduce a couple of the outstanding team members that I've invited to attend today, Brittany Johnson and Stephanie Sampson. Brittany and Stephanie, why don't you introduce yourselves and tell us a little bit about what you do?
Hi, my name's Brittany Johnson. I am the executive director here at NAREA. I am responsible for day-to-day operations, managing all sales efforts and ensuring customer service standards are high and continually improving.
Hi, and I'm Stephanie. I am the media director. I oversee all online content creation area, website, newsletters, social media pages. My job is to keep the information displayed on our site fresh, informative, appealing.
Okay, thanks. I appreciate that. And one thing that you might be interested in with regard to our newsletter, we offer an individual newsletter for each agent that has an interest called Real Facts, which they can send out to their individual clients. And we found that there are several that really like that feature of our program. So to start out with, let's give a little disclaimer. This presentation is real estate wealth building strategies. And although this presentation will present various investment, tax, and retirement strategies, its main purpose is educational. And since everyone has a different financial situation, we suggest that you seek competent financial, legal, tax, and real estate advice. The information presented here reflects mainly my views and is not meant to provide tax or legal advice. The presentation is being recorded, so feel free as we go through the presentation to type your questions in the text box below, and we'll answer those at the end of the presentation. Okay, with that in mind, let's get started. So the topics we're going to talk about today are first, we're going to talk about the Wall Street and financial planning investment model. And then we'll get into why real estate provides a better investment model. And then the third area that we're going to discuss is using real estate investment. And I'm going to give an example of a new development project that we're involved with. And during that, we'll explore some of the various investment strategies that we use, which I think you'll find really interesting. We're going to get into new development, syndication, 1031 tax deferred exchanges, and self-directed retirement accounts. And we plan on doing all that within about 40 minutes, and then we'll open it up to questions and answers at the end. So I thought we'd start first talking about what I can call the Wall Street myth. And most people that are in real estate, that are in financial planning, follow this model to a T. It involves primarily the big brokerage firms in the stock market. And every one of these guys, along with all the financial planners, are under contract by these firms to sell only the products that they provide, which mainly are the ones that are publicly traded. If you're working with a financial planner and you want to invest directly in real estate, it's likely that you're going to get discouraged because they do not recommend investing directly in real estate, nor do they get paid anything by offering advice in the real estate business. So you're not going to get much help from them if you're working with clients and they've got financial planners. So you just need to be aware of that. I just wanted to make a couple basic comments on this. The management fees from these people can range from 1% to 5%, and every mutual fund has a manager. The financial planner is a manager, and all of these people charge fees right off the top. So it's really difficult to get very high returns in the stock market unless you've got a really good financial planner that can direct you to some high performing stocks. The Dow Jones Industrial Average is one of the key benchmarks, and I always get a kick out of this because it includes 30 of the large companies in the business, and these 30 companies, if you total all of their stock values, it's about $3,800, and yet the Dow Jones Industrial Average is about 27,000, just over. And so they put in this weighted average multiple of about 7 times more than the value of the stocks. And so it always gives this inflated view of what the Dow Jones Industrial Average is. If you were to take a company like Berkshire Hathaway and include that in the model, it'd blow the Dow Jones out of the water because their stock value is over 317,000. So, and then if a stock is not performing well in that group, they take it out and replace it with one that is performing well. So you're always in a situation where the Dow Jones average is going up, never down. And financial planners, I believe that most financial planners are doing a great job with their investors, given the constraints they operate under. As I mentioned, they're under contract not to advise their clients about investing directly in real estate. Whenever a client wants to invest directly in real estate, they suggest investing in a real estate investment trust, which is called a REIT. And these are not real estate investments, they're stock investments. And so the financial planner's dream investor is someone who has a high income and high net worth, and then they advise them to allocate their money among various stocks. And these investors have total trust in their advisors, yet most of them have little idea what they've invested in. And for most financial planners, it's all about the assets under management because that's how they get paid. And you're going to be wondering how this relates to real estate strategies, but I'll tie that in just a minute as we get going, because it's very significant that you understand how these guys get paid and how it works. So two of the basic concepts are asset allocation, which is apportioning an individual's portfolio assets according to their goals, risk tolerance, and investment horizon. And the other concept is diversification, which is selecting a wide variety of investments to lower the risk and increase the yields. And here's a basic asset allocation chart with mainly stocks. This is a pretty typical model using diversification. And this model has 10 categories with REITs fitting into the alternative investment category there on the lower right side. The one thing they all have in common is they're all stocks. So financial planners, when they start talking about retirement and building a portfolio for somebody, and in an attempt to determine the amount of money that that person needs for retirement, they use what's called the 25 times rule. Some call it the rule of 25, which basically states that you need 25 times your annual salary to retire comfortably. And so if somebody has an income of $80,000 a year, you'd basically need about $2 million in savings and investments when you retire at age 65. Another concept they incorporate is the 4% rule, which states that you should withdraw from savings and investments no more than 4% of your investment principal each year during retirement. That would give you an average income of $80,000 a year, excluding Social Security and other things like that, which some people are wondering how long Social Security is going to last, but many say it represents about 40% of the income that you should expect at retirement. So here's the interesting thing. It's kind of a problem. If you're making $80,000 a year and you want to retire in 25 years, you're going to have to achieve a significant return to accumulate $2 million. Most people will never make it. If your investment returns 5%, as I'm showing here, you need to invest 65% of your income to get there. Nobody's going to do that. Most people have to rely on paying off their home and using their equity to survive along with whatever Social Security benefits they receive. So it's not a very fun way to live your life where you feel like you're always under pressure of being able to have enough money to retire. So the interesting thing about this, and kind of to make matters worse, with inflation at 3% a year, you're not going to need $80,000 when you retire. You're going to need $167,500 a year just to live and buy the things that you're buying today. So that's where real estate investing comes in. It's the way you can save the day and really help all of those people that you're working with. I don't know how many of you have read the New York Times bestseller, The Millionaire Mind by Thomas Stanley, but he made a really interesting statement in his book. He said, there's something else about the balance sheet of the affluent. They do not place all their investment eggs in one single vulnerable basket. Most are well diversified and most have some type of investment in real estate. Even many of those millionaires who have a strong affinity for common stocks hold some real estate holdings. There is a strong correlation between net worth and the proportion of one's wealth that is invested in real estate. And I can verify that in my own life. I followed the model that we're going to be talking about today. So the key is to start investing directly in real estate, primarily income producing real estate. And I can guarantee you that you can build wealth 2 to 4 times faster by investing in real estate than you can any other way. And here's a couple of the fundamental concepts that you need to consider as you're moving forward with your investment program. First, you need to incorporate the power of leverage and smart debt. Now, I know there are some that advocate a no debt policy, but that's not only unrealistic, but it doesn't help your financial returns. Financial leverage means you use other people's money to increase your return on investment. Unleveraged, so if you're financially unleveraged, that means that you're operating without the use of borrowed money, which reduces the return on your investment. Smart debt means that you use the bank's money to buy large income producing appreciating assets. That's contrasted with dumb debt, which is when you borrow money to buy a car or some other asset that doesn't generate any income and is worthless after 5 to 7 years. So here's an example of financial leverage and how this ties into our building wealth strategy. Say you invest $100,000 in a real estate asset and it generates 8% return a year. That's $8,000 a year. Now say instead of paying all cash, you borrow 75% of the money and only invest 25% or $25,000 of your own money. Because you can borrow money at the bank for less than your debt-free yield, it gives you a higher overall return, in this case of 14%, assuming all other things are equal. This is an example of positive leverage, and it's fundamental to building wealth through real estate. So here's how it compares to investing in stocks. If you invest $100,000 in stocks or mutual funds or ETFs, and you want to say you achieve an 8% return in 25 years, that will grow to about $685,000. It's extremely hard to leverage a stock investment and to get the kind of consistent return in the stock market that you need to achieve your goal, because there are periods of time when the value of your stock portfolio will drop 40 to 50% as it did several years ago. A bear market happens about every 7 years. On the other hand, if you invest $100,000 in real estate, you can buy a $400,000 asset by putting 25% down and borrowing the rest. The entire asset, not just your $100,000, appreciates in value over time. And in real estate, it's not difficult to achieve an 8% return, which means that in 25 years, your wealth has grown to 2.7 million and your debt's paid off. You are in a great spot to have enough money to retire comfortably. You can do that in real estate. It's almost impossible unless you're a high income person to do that in the stock market. So here's an asset allocation model that I like to recommend. I think you should put 50% of your investment capital in long-term income-producing real estate investments. Most financial planners would freak out by me making this recommendation, since they only recommend putting 15% in alternative investments and then only in REITs. So then you can diversify the rest of your portfolio in whatever you want: mutual funds, ETFs, bonds. Usually keep some in cash. That's always recommended. Another investment strategy I recommend is investing in what's called securitized loans. I don't suggest you put your entire portfolio in that or all your cash in that, but we have a lending program through Overland Capital that I invest in, and others of our clients, where we achieve about a 9 to 10% return for those folks. And Overland Capital becomes the borrower, and then we turn around and lend that money to other developers so they can acquire property and construct their projects. These loans are typically securitized by the value of the real estate asset itself. So that's what I like to see as an asset allocation model. Here's how your typical return is broken out when you invest in income producing real estate. And this applies whether you're doing a single family home or whether you're doing commercial investment, but these are kind of the benchmarks that we like to see. The cash flow will make up about 8% of your return. Then you get another 5% or so as the principal on the loan amortizes each year. And then the typical asset will appreciate somewhere between 3 and 6% a year, depending on the market that you're in. And that'll give you an overall yield on your investment of somewhere between 15 to 19%. We try to peg most of our investments at about a 20% IRR, which stands for internal rate of return. And if we can get a 2 to 3 multiple, we think that's a good investment. So let's walk through a real life example here. Now we're going to get into a specific example of how to incorporate several wealth building strategies into a real estate investment. This is a rendering of our 580 unit self-storage project we're building in Mesa, Arizona on Chrisman Road. It's okay to focus on the specifics that I'm going to give you on this project, but what I really want you to pay particular attention to is how I would present this to an investor or group of investors that you're working with. And just kind of look at the layout that I've given, and we'll talk about several concepts and how you can incorporate that into the people that you may work with. So first, this is a real estate syndication, which means that multiple investors are pooling their capital to acquire real estate. And in this case, this is a new development that we're doing. We're called the syndicator. We're also called the sponsor or the issuer. And often the sponsor issuer is referred to as the GP, which stands for general partner. And I wanted to review a little bit about the financials here, because there's some terminology and strategies you'll be getting involved with as you do these projects or one similar to this that you decide to do. So here are the financial highlights. The total project cost is $9.6 million, of which $1.2 million is land cost. And that's significant when we start talking about 1031 exchanges. We're going to raise about $2.4 million in equity capital, and we're going to borrow $7.2 million. The IRR on this project is a healthy 20.1%, and the equity multiple is 2.4. I mentioned that term before, and some investors really are concerned about that term or like to see that term. It simply means that when you invest like $100,000 over the life of the investment, that you'll receive 2.4 times that when it's sold. And so other terminology here that you're familiar with is debt coverage ratio. Anything above about a 1.2 or 1.3 DCR is generally pretty good, and that's what the banks look for. And most investors like to see that you're, as the developer or the sponsor of the project, are investing some of your own capital in the deal. In this case, we intend to buy 4.2% of the total capital. Down below that, you'll see the information on the loan terms. And in this case, we have a bank that has agreed to give us a construction loan, which is prime plus 1.5 with a floor of 7%. That's a 24-month interest-only loan. That's fairly typical. And then the term out, or the permanent loan, is 24-year amortized loan, where they're going to give us the first 12 months interest only, and then a 5-year swap rate, which is 3.5%. The 5-year swap rate plus 3.5%. So our rate will be about 5.42, which is where we expect this to be. And that's lower than the overall return. So in this case, we're going to wind up getting positive leverage, as I mentioned before. We expect this to be a 2.4 multiple, which if they invest 100,000, they're going to wind up getting 244,252. And that basically comes from no return for the first year or two as we build and ramp up the project, but then they start getting cash flow, and the big return comes in the 5th year. Most investors like to see a termination of the investment after 5 years. So you should plan on pegging that. There are different ways to handle that. One way is after the 5th year, you can refinance the project and cash them out then. Another idea is just selling the asset for whatever you can get for it. And in some cases, investors like to stay in long term, and when that happens, then after the 5th year, you usually get an appraisal on the project, and anybody that wants out, you buy them out at whatever the fair market value is, so they get the return on their investment. And then the investors that want to stay in can just keep going forward. So those are 3 approaches or strategies on how to exit a project. In this case, the minimum investment amount is $50,000, and I would suggest that you put a minimum investment amount on each one of the deals that you do. 50 is the lowest we usually do. Sometimes we'll peg the minimum at 100 if we're doing a larger equity raise. Like we just raised $6 million on a 116-unit apartment complex that we're building in St. George, Utah. And we put the minimum of that investment at 75, but gave preferential treatment to anybody that was going to invest 100 or more. And we sold that one out in just over a week. It was amazing. We had to turn away about $750,000 in investment capital. The types of offerings that you can do is a 506B or a 506C offering. That relates to SEC regulations. And 506B offering, you can sell to an unlimited number of accredited investors. And an accredited investor is somebody that has $1 million of net worth excluding their primary residence. Or And if you're doing a 506B, you can include some non-accredited investors up to 35, but you have to be careful with that because you can't do general solicitation if you're doing a 506B offering. You have to sell just to the pre-existing business relationships that you've established. A 506C offering, which this one is less limiting in terms of advertising, but more limiting in terms of who can invest. On a 506C offering, you can only bring in accredited investors, no non-accredited investors. However, you can do what's called general solicitation, so you can market to everybody. And that opens it up for you to raise more capital. So most of our investments are 506C offerings, unless we're doing a smaller investment product, then we'll do a 506B. And most of our offering structures are 80-20, meaning the limited partners or the members of the LLC, which is how these are usually structured, get 80% of the investment, and the general partner or the manager of the LLC gets 20%. And we typically offer a preferred return, so we don't take any return until we've given the investors 8% and their money back, and then our returns kick in. And sometimes you'll see situations, and this will be one of those, where after they get all their cash back, after they get their preferred return, and we've hit their return that we promised, we will then switch to a 60-40, where the GP gets 40%. Because at that point in time, they've got all their cash back. Now you're playing with house money. So it's just another way of expressing the projected returns. Nothing in the first 2 years, even though they're accumulating a return of 8% in those years. And then we have 9.9% in year 3, and year 4 it goes down a little bit because that's when our permanent debt kicks in. But in the 5th year, that's when they really make their money. We sell the asset and they get a 229% return that year, which is crazy, to give them an overall 20.1%. So I usually then, after giving them some of the financial information, I start talking about where the project is located and what some of the things are that are important about the area that we think make this a great reason to invest. So here's just a sample, kind of a map showing the Mesa area in relationship to Phoenix and Scottsdale and Tempe. They're to the west and the northwest, and then Gilbert and Chandler are to the south. Our project is located right where you see the arrow. And Mesa is the 3rd largest city in Arizona, next to Phoenix and Tucson. It's the 35th largest city in the nation, with a population of over 500,000, and there's about 200,000 households. And our project is located where SR 202, which is called Loop 202, converges with the Superstition Freeway, which is also known as US Route 60. It's called Superstition Freeway because of its proximity to a mountain called Superstition Mountain. So, and then we like to talk about things like the growth in the area and any revitalization that's going. In this case, it's downtown, and then a little bit about the climate, a little bit about new development that's happening in the area. And then we focus on things like employment, and you can see here that the U.S. has increasing in employment about an average of 1.9% a year. Tucson's at 2.7%, or Arizona's at 2.7, and Mesa's at 3.1. So it's got a really healthy growth employment factor going on. In fact, they added 65,500 year-over-year non-farm jobs. And the median household income is $70,995. That's a pretty healthy figure and bodes well for the investment that we're doing. You can see we're kind of building in an infill site. There's a lot of rooftops around us, so that makes for a great investment model. And we like this area so much that we not only bought the 2 acres that we're building the self-storage project in, but we bought another 10 acres down the road a little ways that we're going to be doing a mixed-use development, which will include a 96-room hotel and a 240-unit apartment development. So we love this area. And Crisman Road, which is where it's located, has 19,000 cars a day. If you're building a new self-storage project, you should look at areas that have at least 10,000 cars a day going by, which cuts down on your advertising and helps you with your potential rent-up. Feasibility study, we always get a feasibility study every time we do a project, and their comment was the visibility is excellent to the neighborhood market. You can see the 2 land areas that we're acquiring and the road. So, and then we talk a little bit about demand and supply. In this case, the ratio is 6.15. That means you can have 6.15 square feet of rental space for every resident. And here we show a population of 60,508. So that means you can have a total square feet in the surrounding area for self-storage of 372,385. And so that's our demand. The entire supply in the area is 359. So we've got a positive 12,000 square feet, including our project. So this is just basically saying that this is a good project in a good area, and always get a feasibility study, because that third-party verification is really important. Sometimes you can do that with an appraisal, but usually it's some type of feasibility study if you're doing a larger project. If you're doing a really small project, maybe you can provide that information that they need to have the confidence that it's a good investment. We also take a look at the competitors in the market. In this case, we're right in the center of that bullseye, and we have 2 extra space competitors near us, not within our immediate proximity, but just outside. And we like to see these major players in the market, because the typical mom and pops, which is the U-Store and the Signal Butte storage projects, they will not drive rate. But companies like Extra Space, if you're a major player, they will really drive rate. And so that's why we like to see them around. And in our market area here for this project, excluding U-Store because it's under construction and hasn't stabilized at all yet, but the other 3 competitors, which have been in operation for a few years, are averaging 97% occupancy. That's crazy high. And so one strategy that you need to have is you need to do a really good job with the competition in the area, find out where they're at, find out what is a good occupancy rate that you're not only comfortable with, but will support your project. And usually in self-storage, if you're above 85%, you probably got a pretty good deal going. But in this case, it's 97%. So it's this is a really strong market. And let's talk about how you raise the equity capital and how you get investors involved in these types of transactions to help them build the wealth that they're looking for. Usually we set up a program where we create an LLC. In this case, it's called Overland Storage Mesa AZ LLC. And we bring in cash investors and people that have self-directed IRAs and 401ks. I'll talk about that in a minute. But they come in and invest directly in the LLC. We also open it up for 1031 investors. Now, I give a couple classes on 1031s, but as you know, a 1031 investor must do what's called a like-kind exchange, which means they're investing real estate for real estate. They cannot they cannot come out of a real estate investment and then go directly into an LLC, because that'll disqualify their 1031. So what we try to do on new developments, we carve off the land and make that available to 1031 investors. And then they're coming out of a real estate investment, going into a real estate investment. And we set it up in a way that they get a percentage ownership of the land, they become a co-owner. And then when we do the development, the cash that they've invested goes in relationship to everybody else's cash, and they get an ownership interest in the finished project. So, and those two come together in what's called a tenant in common agreement. Some call it a TIC agreement. In the 90s and early 2000s, TICs got a really bad reputation because there were some unscrupulous TIC managers that took advantage of the partners. In our case, that's not the situation, because we guarantee both the construction and the takeout loan. We're an investor in the project. We've got a real vested interest in seeing that the project succeeds. So, but most of those are handled through a TIC agreement. And so on a 1031 investment, you'd work with somebody. So the seller would enter in, the seller of the relinquished property that they're getting out of would enter into a real estate contract with the property that they're buying, and they'd come in through a real estate contract, and the investors coming in through the LLC, they come in through a subscription agreement, and then we make sure that the TIC agreement is governed by the operating agreement of the LLC, so everybody is treated the same. The other thing that I wanted to mention was 1031 tax, or 1031, sorry, self-directed 401k plans and other self-directed retirement accounts. Most financial planners get people buying or creating IRAs that are traditional IRAs. Not a very good model. You're much better off doing a Roth IRA, which basically says you're investing after-tax dollars instead of pre-tax dollars. But the benefit of a Roth IRA is that, hang on just a sec. The benefit of a Roth IRA is that that the taxes on the Roth IRA are never paid. it's tax-free instead of tax-deferred. And so you don't create a situation for your investors where as you get them in a deal, they have to worry about when they come out of the deal not being able to take advantage of capital gains tax, but have to pay ordinary income taxes. So I always recommend investing in getting a Roth IRA set up. The other thing I recommend for every real estate investor out or every real estate professional out there to sign up for their own individual 401k. 401ks have a ton of advantages over IRAs. You can build wealth much faster through your 401k because you can invest a lot more money in a 401k than you can an IRA every year. And there's some significant tax advantages to 401ks that I won't get into here, but just trust me that they exist. And I wanted to mention kind of one thing in closing. If you're a real estate professional, you really should be trying to build wealth through real estate investing. You have some significant advantages over other investors. Everybody kind of gets the tax benefits, which is mortgage interest deduction and depreciation and those kinds of things. But as a real estate professional, which means you can look up the definition, but it's basically you're spending 750 hours a year as in the real estate business. You can write off passive losses against ordinary income and significantly reduce your tax consequences every year. And that additional capital can just go back into building your portfolio. So I hope this has been beneficial. We've talked about a bunch of different strategies, putting together syndications, 1031s, self-directed retirement accounts, how we put together a model to invest in these types of assets. And now I'd like to just open it up to any questions anybody might have for a few minutes. We put a little poll on the screen, so if you wouldn't mind as we're going through any questions, if you wouldn't mind taking the poll, we'd really appreciate it. Hey, this is perfect. We have no questions. So if anybody has a question out there, we'd be happy to answer it. If not, if you'd please take the poll, we would really appreciate that. And if you need to get in touch with me, let me give you my contact information. Here's the contact information on the screen for the company. But my direct number is 801-231-6650. And my email address is kholman@overland, overland corp, which is corp.com. So enjoyed spending a few minutes with you, and we'll sign off. Thank you for your time.